Welcome to this Killick Explains video. This week I want to do something a little bit different, which is to take a look at the results of a Twitter poll that I ran under my name Tim Editor Killick, for those people who want to find me and find it, and just take a look at one or two of the results and what they mean for the way you approach investing. So the question essentially boiled down to, what is the most important ingredient when it comes to stock market success? That was the gist of the question that I asked. And there were four possible answers: luck, costs, i.e. keeping costs down, the right mindset, and timing. Now, what I want to do is just take each of those in turn, finishing with the winning answer, if you like, which I have to say I agree with, and just deal with what actually is the secret to successful investing. First of all, luck. Now, 12.3% of the people who responded said it's all about luck. But actually there's an old cliche that says, the harder I work, the luckier I get. In other words, ascribing everything to luck is a little bit sour grapes in my opinion. And it also leaves you completely open to the vagaries of the market. If you're just effectively sticking a tail on the stock market donkey with no clue as to where we are within a particular cycle, no clue as to why you're buying into a particular theme, sector or stock, no idea about the time horizon you plan to invest over, then luck may seem to play a disproportionate part in your returns that you make. But actually, stock market investing, like a lot of life, is not based on pure luck. So that answer didn't get the top score. Next, costs. Now, 7.5% of you decided that costs actually are the key factor. And I suppose the reason why more people didn't answer with costs is this: yes, over the long term, big costs can act as a serious drag on your investment returns, and you must always be alert to the costs that you're paying. And I've done other Killick Explains videos on costs. You need to be aware of what you are paying to a fund, for example, if that's the route you take in terms of investing your money. You need to know how much you're paying to advisors. You need to know how much you're paying in platform fees. You need to be aware of tax, drag, stamp duty and the like. But ultimately, if you pick the wrong set of investments, low costs are not going to bail you out of that decision, in effect. You'll languish, not earning much, not paying much, but what's the point of that, if you like? So there is a balance, performance versus cost. So it's correct always to think about cost. It would be wrong of me to say that you can simply forget about it. That's clearly incorrect in anything that you buy, whether stocks, cars, houses and the rest of it. But cost is not the main factor in long-term stock market success, in my view. Now, next up was timing. 20.5%, or around a fifth of the people who answered the poll, so it's all about timing. And this is quite a tempting answer. Boy, so-and-so got lucky, he got in at the bottom, sold at the top. Wow, if everyone could do that, we'd all be incredibly wealthy. The problem with taking timing as the way to make money is it's actually incredibly difficult to do other than via pure luck. It's really hard to outwit the rest of the market and buy at the bottom of a particular cycle, and it's equally hard to sell right at the top because everybody else is trying to do the same thing. You're up against all the professional traders, the algorithms, other individual investors who are out there, and so on. And the reason it's not only difficult but ill-advised was written about by JP Morgan. They've done studies of the stock market over 10-year periods. One of them was the 10-year period 2003-2013, for example. And they reckon that anyone trying to time the market, so imagine watching the market drop and then trying to get in at the bottom, runs the risk that they then miss the bounce. And JP Morgan's thesis was that some of the sharpest rises in the stock market come after the steepest falls, the very next day in a lot of cases. And that's just to do with the way markets behave. So, my point, miss basically just 10 of those great investing days, which tend to come right after some of the worst ones, immediately after, get that wrong, and you could halve your long-term returns over a 10-year period from the American S&P 500 index. Halve them just by missing 10 of the best investing days. So that makes market timing incredibly dangerous. Yes, of course, people who get it right somehow will brag about it. They'll tell you about it. They'll say, I can't believe I got into this particular stock early, then I got out. Look at the money I made. But unsurprisingly, you tend not to hear about the stories that have not gone so well for those same investors. They don't tend to warn you and say, well, look at how much money I lost when I got my market timing wrong. So market timing is not the right answer. So what is? And I'm pleased to say that 59.6% of the people that entered the poll, if you like, went with the right mindset. The most important thing a long-term investor should have, the secret weapon in their armory, is thinking correctly about the way they invest. Now, this is a massive topic. This is almost the psychology of investing, but it's about avoiding certain key traps. And I'll just list a few of them to finish off on this particular video. So, for example, gambling on single stocks is a no-no. No company is too big to fail. I found that out over the years the hard way, putting money into stocks like Jarvis, like Carillion, where I thought, this couldn't possibly get any cheaper, and then the share price has actually got a lot cheaper and then gone to zero as the companies in question have effectively gone bust. So putting money into single stocks, even the BPs of this world, the Marks and Spencers, the Tescos have shown that they are not immune from making mistakes. They're not immune from natural disasters. So that's a no-no. Running a diversified portfolio illustrates that you have the right mindset. Diversified across sector, theme, different types of stocks versus bonds, and so on. Next, a long-term mindset. This is not short-termism. We're not going into the market at any point trying to make a quick buck on the latest healthcare tech stock or whatever it might be. The right mindset is long-term. Investing, as a Nobel Prize winner once put it, should be like watching paint dry. It's steady as you go. It is getting rich slowly through the awesome power of compound growth. Next, anchoring. Don't look backwards. Although the past can be some kind of guide to the future, history doesn't repeat, but it does rhyme, as Mark Twain once put it. Be very careful about anchoring. I've talked about this before. I got fixated in the early 90s on the idea that house prices were falling, and groups of friends and myself stayed away from the market for far too long. We anchored to data that became quickly irrelevant as some of the reforms of the property market came through. During the recent pandemic, people have anchored to the massive drop in the market we saw as the pandemic struck. Some people were terrified by that, never went back into the market, whereas had they stayed invested, even in a broad range of equities throughout 2020, they could have made something like 11 or 12%, depending on which index you look at. Okay, so anchoring. Then there are the sort of the optimism biases we have. I'm a better than average driver, a better than average drinker, a better than average investor, but we forget somebody's got to be the average and somebody's got to be below the average. So we get overconfident, particularly with a little bit of success, which we ascribe to luck. All right, now there are many, many more. Okay, crowd following, not being able to make your own judgments, not being sometimes prepared to stand back and ask whether something as a trend or a movement in a stock price can continue. These are all the kinds of things which are linked to mindset. It's difficult to just wake up one day having never invested with the correct mindset, but over time it's definitely possible to develop the right mindset. So there you have it. There was the poll. Is the secret to stock market success luck? No. Costs? No, certainly not entirely. Timing? No. Mindset is a yes.